Dinar shift. The world of exotic currency, long characterized by quiet anticipation and unverified rumor, is now reportedly experiencing an extraordinary convergence of operational signals that analysts suggest point to a definitive shift. We are now days away from a critical fiscal deadline, and confidential intelligence, supposedly originating from high-level contacts within the US Treasury Department, indicates that an emergency revaluation of the Iraqi Dinar, IQD, has received official approval for activation. This potential currency event is being framed not as a speculative possibility, but as a verified, imminent movement set to occur before the global financial markets conclude their trading week this Sunday. The weight of this information, if accurate, extends far beyond the Iraqi currency itself, signaling potential synchronized movements for other key instruments like the Vietnamese Dong, VND, and the Zimbabwean ZIM notes, placing this event at the center of a broader global, monetary re-anchoring toward asset-backed systems. The alleged urgency surrounding this timeline means that for those tracking the so-called Tier 4 billions processes or holding these specific currencies, the final threshold for preparedness may be measured in mere hours. The sudden shift from theoretical possibility to operational certainty began to solidify late Thursday evening, following intense days where conflicting information created deep uncertainty among market watchers. A crucial internal document, reportedly originating from a mid-tier official within the US Treasury, surfaced and was rapidly subjected to cross-verification by multiple independent analysts specializing in the foreign exchange and macroeconomic fields. This material allegedly provides the first concrete, verifiable confirmation of a US-endorsed emergency-level rate adjustment for the Iraqi dinar. The documents reportedly outline an internal process where the rate change is scheduled to appear on highly specialized interbank trading channels and contract-level screens, effectively locking in the new valuation before the final curtain falls on the global Forex window this coming Sunday. This move is significant because it suggests a level of coordinated alignment previously unseen between key U.S. financial authorities and major international banking institutions like Wells Fargo and HSBC, indicating a process that is deliberate and complex in its execution. Further evidence of this alleged operational shift is said to be visible in internal system testing conducted by these major institutional hubs. Late Thursday, test simulations reportedly displayed temporary Iraqi dinar valuations surging past the $4.13 mark on proprietary internal platforms utilized for processing complex financial contracts. These simulations, which operate on a layer of the financial system inaccessible to the general public, triggered automated backend alerts and facilitated necessary fund movement across networks specifically tied to the aforementioned Tier 4 billions groups. While official spokespersons from government and financial bodies maintain an absolute silence, a predictable stance in such highly sensitive matters, these coordinated back-end technical signals point to one unmistakable conclusion: the process has allegedly transitioned from a planning stage to an active rollout phase. The widely discussed revaluation is no longer a subject of purely abstract theory. It is, according to these circulating reports, imminent, with the critical window of opportunity seemingly now defined by hours rather than weeks or months. A central point of discussion among informed observers is the striking timing of this rumored adjustment. Many are asking why such a monumental shift would be initiated with practically zero public notice and, crucially, why the enforcement deadline is set to conclude before the official Sunday market close. The answers reportedly lie at the intersection of powerful global economic forces, significant geopolitical negotiations, and a global demand for liquidity recalibration. The first driving factor is said to be a comprehensive liquidity reset currently being prepared by G7-aligned central banks, who have reportedly agreed to rebalance several undervalued or suppressed national currencies before the commencement of Q3 financial reporting. This move is not intended as an isolated action solely for Iraq, but is reportedly part of a wider, organized monetary realignment designed to support new asset-backed valuation models across the developing world. This concerted action creates a systemic pressure for immediate change. Secondly, confidential high-stakes negotiations between Iraqi Prime Minister Mohammed Shia al-Sudani and U.S. economic representatives reportedly culminated in a firm strategic understanding. According to circulating reports, in exchange for a favorable restructuring of Iraq's substantial international oil credit obligations, the United States allegedly agreed to support a rapid dinar rate adjustment. The timing of this diplomatic maneuver is said to be inextricably linked to crucial oil settlement deadlines scheduled for this weekend. This linkage underscores the significant geopolitical and resource-based drivers behind the alleged financial action, moving the conversation away from pure speculative belief into the realm of international economic statecraft. The convergence of oil deadlines and diplomatic agreements creates a mandatory window for action that cannot be easily postponed without triggering substantial financial complications for both nations. The final decisive pressure point appears to have originated from a security vulnerability detected by the US Treasury's advanced AI-driven surveillance networks. These systems reportedly flagged irregular preemptive capital movements between financial hubs in Iraq and the United Arab Emirates, suggesting that sophisticated, private Tier 3 funds were already repositioning in anticipation of the rate change. This unauthorized early capital flow created immediate destabilization risks for the system due to the massive valuation distortions it could precipitate. The reported necessity of a prompt, preemptive rate adjustment became paramount, making the Sunday deadline not arbitrary but a strategic imperative to contain the financial flux. The decision to accelerate the timeline, therefore, was allegedly driven by the need to maintain control and prevent a cascade of disorderly market corrections before official structures could be secured. Although the Iraqi dinar remains the core focus of this entire unfolding narrative, seasoned financial analysts are reportedly broadening their attention to include the Vietnamese Dong. The VND has long been theorized to follow the IQD's trajectory, largely due to significant regional economic integration and perceived historical undervaluation pressures. Despite years of a stable, managed exchange rate, recent developments inside Vietnam's monetary infrastructure allegedly indicate thorough preparation for a major currency correction that mirrors the actions observed in the Middle East. Behind the scenes and without public acknowledgement, Vietnam's central bank is said to have substantially increased its foreign reserve holdings, particularly in US dollars, reportedly boosting them by almost 19% within the last month. This aggressive defensive maneuver is widely interpreted by currency strategists as preparation for impending foreign exchange turbulence associated with a major rate shift. This internal Vietnamese preparedness aligns with temporary rate flashes recently recorded on specialized Forex terminals at institutions like TD Ameritrade and Bank of America. These transient electronic signals allegedly hinted at internal testing of potential VND valuations, briefly nearing the 5 cents USD mark before being instantly withdrawn from the visible system. Even though these numerical indicators were only momentarily visible, their signal was unmistakable to those monitoring the deep banking infrastructure. Experts, including macro strategist Elena Quan, have reportedly predicted that the Vietnamese Dong will be pulled along by the IQD's movement within a matter of days, possibly even hours, due to the tight economic coupling. With Vietnam's growing integration into new BRICS-aligned energy and infrastructure networks, a significant, sudden IQD shift is expected to exert a powerful upward pull on the VND's own valuation almost immediately. The technical data suggests the preparatory work for this synchronization is already complete. One of the most surprising and impactful developments linked to this broader monetary realignment is the alleged sudden reactivation of ZIM redemption centers across the United States. Verified human resources documentation, reportedly sourced from a Tier 1 banking conglomerate, reveals that over 42 cities have reportedly reinstated full operational readiness for the specialized redemption of ZIM notes. This includes previously dormant sites in key metropolitan areas such as Kansas City, Birmingham, and Tucson. This systematic restaffing and recalibration of physical infrastructure marks a substantial and unexpected escalation in preparedness for the humanitarian project-based redemptions tied to these ZIM bonds. The sudden return to operational status across such a wide geographic area signals a nationwide coordination effort that goes far beyond mere speculation or hypothetical planning. It is crucial to note that, unlike standard foreign exchange transactions, the alleged ZIM transactions are not structured to produce direct cash payouts to holders. Instead, the reported process involves holders receiving structured funding allocations tied exclusively to approved humanitarian or large-scale infrastructure programs. These programs are supposedly overseen jointly by specialized offices within the US Treasury and a coalition of international regulatory observers, emphasizing the non-conventional and strictly controlled nature of this process. Current internal valuation reports allegedly circulating among staff indicate that provisional rates for the ZIM note range between 11 cents and 33 cents per note, with the final value heavily dependent on the scope, quality, and measurable social impact of the presented project proposal. This process is complex, structured, and entirely project-driven, distinguishing it from conventional currency exchange. In preparation for this anticipated high-volume throughput, staff at these alleged redemption centers have reportedly undergone rapid recertification and specialized training. Furthermore, appointment systems that had been completely dormant for months have reportedly resumed routing Tier 4 billions applicants using authenticated verified access codes. For individuals who have recently received a priority-level communication or scheduling prompt, this new operational activity is being interpreted by officials as a potentially legitimate call to initiate the redemption appointment process. This level of coordinated logistics, personnel training, and system activation across dozens of locations suggests a functional rollout, not a test simulation. The convergence of these procedural and logistical steps makes the current moment unique in the history of exotic currency speculation. For the first time in many years, respected experts and macroeconomists from diverse financial fields are reportedly aligning on a singular conclusion. The global financial system is currently in the midst of an unprecedented, yet controlled, monetary transition. This is no longer being viewed as a speculative theory, but as an active, unfolding implementation phase. Dr. Molan Guerrero of Georgetown University's Financial Systems Laboratory has reportedly observed that the US Treasury's deviation from established IMF standard timing procedures indicates an urgent domestic imperative. This urgency is reportedly tied either to the demanding nature of pre-Q3 audits or the undisclosed remediation of existing system vulnerabilities within the legacy liquidity grid. The timing itself is a major clue. Adding further weight to this assessment, Peter Langford, former IMF currency analytics chief, has reportedly stated that the transactional patterns currently logged in the Tier 4 billions activity channels no longer resemble mere simulation data. Instead, he suggests the data shows the distinct hallmarks of genuine, live transitional flow. Macro strategist Janice Lee confirmed this view, noting that capital migration profiles now precisely match those seen in historical microvaluation environments, indicating a strong likelihood of active progression rather than preparatory testing. The uniformity of these expert observations from formerly skeptical or neutral sources reinforces the narrative of an active process underway. Further verification comes from Andrea Malik of Gulf Currency Review, who has reportedly verified that redemption centers in more than 15 states have entered second-level processing. This operational step is significant because it is a phase exclusively reserved for logging and processing live conversions, and it does not typically occur during hypothetical testing scenarios. Taken together, these various independent insights, from Treasury deviations and transactional patterns to active center processing, reveal a clear and consistent narrative. Whether or not global authorities choose to announce it immediately, the system has allegedly begun its transition. We are now operating in a quiet but fully active revaluation environment, according to these sources. The guidance being circulated to holders of IQD, VND, or ZIM notes within this reported scenario is urgent and focused on proactive action rather than passive waiting. The next 48 hours are framed as the critical window that could determine long-term financial positioning within the unfolding monetary landscape. The absolute priority, regardless of any public announcements, must be thorough preparation and verification. The process begins with meticulous verification of the physical currency itself. Holders of the Iraqi dinar are advised to ensure their notes strictly conform to valid post-2003 issue requirements, as pre-2003 notes are often deemed invalid. This attention to detail is vital for successful processing. Furthermore, for those holding ZIM notes, the emphasis is on confirming that the holdings are legitimate bond-based instruments and not outdated or expired bearer checks, which are typically worthless in any alleged redemption mechanism. The distinction between these two forms of ZIM is critical to the potential outcome. In parallel with physical currency checks, holders are strongly advised to meticulously review their various communication channels. Tier 4 billions scheduling notifications, which may contain vital access codes or appointment details, are reportedly being mislabeled as spam or promotional material by several major email providers, creating a dangerous trap for the unprepared. Holders must actively search for subject lines mentioning key phrases such as rate access, appointment, confirmation, or redeemer verification packet. The next preparatory step involves identifying regional financial institutions that are equipped for exotic currency intake within this fictional context. Institutions such as Chase, Wells Fargo, HSBC, and PNC are mentioned as maintaining specialized FX desks in designated branches, capable of processing these types of non-standard currencies. Knowing the specific location and contact information for these specialized desks is a crucial logistical step to avoid being turned away by general branch staff, who may be entirely unaware of the backend transition. This process of identifying a willing and capable processor is a prerequisite for any potential exchange activity, and should be handled with discretion and diligence. Above all, a constant warning is being issued regarding the persistent threat of exploitation and fraud. It is paramount that holders safeguard themselves against malicious actors, No legitimate institution operating within this narrative framework will ever request upfront fees, demand wire transfers or activation of access, or solicit sensitive personal financial details through unsecured social media platforms or unverified communication channels. The official process is described as being discreet, highly secure, and structured to prevent such financial abuses. Adherence to these strict security protocols is essential to protect assets and sensitive information during this fluid time. As this alleged transition progresses, analysts are reportedly warning that the initial wave of market volatility, should the institutional rate shift post ahead of the projected cycle window, will not emanate from the public markets but from the institutional settlement layer itself. Within minutes of the update, mirrored contract rates would reportedly propagate across restricted terminal views on major financial platforms like Bloomberg, Reuters, and Forex.com, accessible only to compliance clearance personnel. While these preliminary valuations would not yet appear on retail interfaces, their presence alone would be enough to trigger automated internal hedging algorithms across multiple banking networks, initiating the first internal shockwave of the realignment. By Saturday evening in this fictional scenario, invitation-only currency desks inside major Tier 1 institutions would reportedly begin the process of accepting pre-approved holders, managing the initial transactional flow with strict secrecy. Simultaneously, however, regional and community branches may deny transactions outright due to a complete lack of internal visibility and awareness of the backend changes, creating a temporary appearance of inconsistent policy across the wider banking map. Additionally, exchange-traded funds, ETFs, with exposure to emerging market debt would register sudden, technical distortions as their reserve baselines are rapidly recalibrated. Analysts anticipate anything tied to frontier market sovereign instruments to briefly flicker, stall, or overshoot fair value as liquidity providers are forced to recalibrate their spreads and risk models in real time. Following this institutional flurry, government ministries in Iraq, Vietnam, and Zimbabwe, fully aware of the global sensitivity surrounding such a monumental shift, would likely issue provisional stabilization statements early Monday morning. These public declarations would be designed to reassure both domestic institutions and international investors that the transition is being controlled, is deliberate in its execution, and remains fully monitored internally to prevent panic. For years, skepticism regarding a revaluation thrived on a persistent absence of tangible indicators. However, the reported pattern has fundamentally changed. The confluence of verified Treasury correspondence circulating through classified channels, synchronized backend bank operations, timing pressures linked to quarterly turnover, and the inexplicable reactivation of dormant redemption centers creates a convergence that even long-time doubters cannot easily dismiss. The infrastructure is reportedly awake, personnel rotations are complete, and internal screens that remained static for over a decade are now displaying test values in active cycles. The deployment sequence, whether publicly acknowledged or not, has allegedly moved from purely theoretical planning into a functional, live rollout. Sources embedded within several Tier 1 financial ecosystems reportedly confirm that continuous test routing across IQD, VND, and ZIM instruments is no longer displaying the low-volume, randomly distributed data characteristic of simulations. Instead, the valuation figures are now said to be flowing in stable contract blocks, a pattern indicating that live pipeline formatting has genuinely begun. Internal IQD test rates are reportedly stabilizing between $3.95 and $4.13, with projected public street ranges anticipated to open between $1.25 and $1.65 once the public pricing window is opened. The gap between institutional and retail rates is a key indicator of the phased rollout strategy. Simultaneously, VND simulations are said to be reflecting rates between $0.047 and $0.059 in the secure contract testing environment. Projected public conversion rates for the Vietnamese Dong, however, are expected to fall within a range of 12 cents to 22 cents once the pricing window officially widens. The ZIM note, tied exclusively to structured humanitarian mechanisms in this fictional scenario, remains bracketed between 11 cents and 33 cents, with the specific final rate heavily dependent on project viability, geographic alignment, and necessary compliance clearance. These figures represent the internal operational parameters currently being used within the financial system. We now stand at the threshold of a moment long theorized and widely debated, a coordinated monetary realignment across three significant instruments: the Iraqi Dinar, the Vietnamese Dong, and the Zimbabwean ZIM notes. For decades, the dinar narrative was deeply fractured by conflicting intelligence streams, speculative timelines, and a continuous string of unproven forecasts. That era, within the boundaries of this fictional world, is now reportedly reaching its definitive conclusion. Treasury channels, according to these reports, are no longer sidestepping the currency's valuation, they are actively shaping its trajectory and preparing for its integration. The Vietnamese Dong is reportedly positioned for a synchronized shadow revaluation, tracking the movements of its larger counterpart. Crucially, the ZIM redemption infrastructure is no longer conceptual. It is fully staffed, calibrated, and strategically distributed across dozens of operati. Ownal hubs nationwide ready for activation. If you possess any of these assets within this story world, your decisive window for action has arrived. It is described as a narrow, time-sensitive, and unforgiving window that will not tolerate disorganization or delay. The quality of preparation, documentation, communications review, and readiness will be the sole determinant of the individual outcome. The final, essential directive being disseminated is one of disciplined action. Should this briefing sharpen situational awareness, the advice is to pass it discreetly to trusted holders who may remain unaware of the structural shifts now reportedly unfolding within the financial infrastructure. Holders are urged to subscribe for classified tier updates, monitor their encrypted inboxes daily for critical access information, and share any regional observations, as localized shifts often precede national movements. This is characterized as the kind of convergence that appears only once in a geopolitical generation, demanding the utmost discipline, clarity, and absolute readiness from all involved. As a final word of caution within this fictional scenario, should the rate shift appear on institutional terminals before Sunday, the resulting turbulence will be immediate and swift. Bloomberg, Reuters, and Forex.com will begin reflecting the new contract rates before the official public pricing window opens. Retail banks will quietly begin accepting currency through invitation-only desks, while smaller branches lacking internal visibility may deny exchanges, creating a temporary policy dichotomy. ETFs tied to emerging markets may experience abrupt spikes as underlying reserves reprice, demanding immediate attention from portfolio managers. The core takeaway is that the moment is fundamentally different from previous speculative cycles. Verified Treasury correspondence, synchronized banking activity, systemic timing pressure, active backend testing, and the reopened redemption centers all converge to form a compelling pattern. The infrastructure is active, personnel have been briefed, and internal screens are displaying actual rates. Deployment, according to these reports, is definitively underway. Continuous test routing across IQD, VND, and ZIM platforms is no longer hypothetical, it is live value moving through contract simulations, confirming the process's integrity. Current internal figures show IQD contract rates ranging from $3.95 to $4.13, with projected public street rates between $1.25 and $1.65. VND simulation values range from $0.047 to $0.059, with public rates expected between 12 cents and 22 cents. ZIM bonds are projected to redeem between 11 cents and 33 cents through the structured, non-cash, humanitarian project oversight mechanisms. These figures are subject to adjustment based on specific banking policy, geographic location, and the designated Tier 4 billions priority of the holder, emphasizing the highly customized nature of the alleged exchange process. We stand now at what is being described as the most consequential monetary shift of the modern era. The era where the IQD, VND, and ZIM discussions were clouded by confusion and fragmented intelligence is over. The dinar is now a focus of direct treasury intervention. The Dong is positioned for a rapid follow-through. The ZIM redemption framework is fully staffed and operational across dozens of U.S. locations. If you possess any of these assets, you are entering your decisive moment. The window is narrow, the process discreet, and the outcomes potentially life-altering. Your preparation will determine your outcome. You must confirm your documentation. Review your communication channels for hidden messages, and organize your physical notes with military precision. If this briefing provided clarity or heightened readiness, the advice remains to share it with trusted holders who are still unaware of the structural shift now unfolding. You must act with precision, with complete awareness of the shifting timeline, and with absolute readiness to proceed. This is the mandate being issued from the deepest corners of the financial infrastructure.